Hi, my name is Vu. I'm a CPA. Here's my certificate if you guys want to see what it looks like. In this video, I'm going to spend approximately 15 minutes to cover 3 areas I think that are important to know going into either your Assurance Elective exam or your CFE Day 2 if you picked the assurance role. This video isn't meant to cover everything in assurance, but it will touch base on 3 important topics that I would rank top on the list of things that you should know. The 3 topics being direct testing of accounts and RAAP, and assessing controls and and special reports to issue. So starting with 1, direct testing RAAP. If you encounter a case where it asks you to prepare some form of audit planning memo, this sequence you always want to do is financial reporting issues first, because these affect the audit planning memo that you're going to write. So you want to quantify the financial reporting issues and provide journal entries to fix the previous incorrect entries. Be sure to analyze the accounting issues in accordance with the framework, whether if it's IFRS or ASPE, based on the case facts. So I'm not going to cover the entire RAAP process in this video. The RAAP process is the format that you would apply when you write an audit planning memo, but just to simply show how RAAP plays a part in the RAAP discussion process. So first, by identifying the financial reporting issues, you identify the specific assertion level risk, factors that would increase the risk of the engagement that you can use to contribute to your risk discussion, or the R section of your RAAP layout. So second, by identifying the financial reporting issues, you would also identify the journal entry adjustments that need to be made to the balance sheet or the income statement to correct the financial reporting issues. This impacts your materiality, which is the M part of your RAAP layout. And because you want to use the corrected, normalized, adjusted balance to calculate your materiality and performance materiality, it should be based on the percentage of the corrected revenue or total assets, etc. And then third, by identifying the financial reporting issues first and the risk to those accounts, you can now apply the respective assertions in that account and then the procedures for those assertions. So as a quick refresher, balance sheet assertions have 4. Okay, so first is existence, second is completeness, third is rights and obligations, and then fourth is valuation and allocation. And then for income statement assertions, those have 5, being occurrence, completeness, classification, fourth is accuracy, and fifth is cutoff. It's important that you know the audit assertions by heart. I've created a video dedicated to the audit assertions, and I'll link to that video in the video description below for your convenience. Let's do one example together where we apply the RAAP format. So RAAP being R for risk, AA for account and assertions, and P for procedures. Risk is your purpose. It always starts with identifying the risk, or aka the problem. If you don't have a risk, there's no need for any audit procedures. And then account and assertions. Assertions will determine the direction of your testing. So generally, as existence and occurrence, you will test from management records to the evidence, while for completeness, you will test from evidence to management records. And then for procedures, trying to provide at least 2 audit procedures. Explain what evidence you will look at, how will this address the risk of misstatement for that account, what specific documents you are going to examine, and what details you will look for in those documents. Do operating expense as an example. So the risk is the understatement of expenses, because management has the incentive to make their income statement look stronger by showing that they are effective at managing their expenses by keeping it low to result in a higher net income. So our main assertion, or our assertion of interest, is completeness of expenses. The testing direction for completeness is therefore we will test from evidence to management records. The reason we test from evidence to management records is, for example, let's take a look at the slide. So on management records, it may have, let's say, 2 line items of $10. And of course, if we select from those 2 line items, we agree the GL details to the invoice and the payment. The details can agree just fine. But in reality, in actual reality, what if management records actually was supposed to have 3 line items that total to $30? If we had selected from management records that showed a total of $20, we would have never known about the 3rd item. We have to test backwards. So from the evidence back to management records to ensure that the records are complete. And then for account is operating expense on the income statement, assertions and procedures. Our income statement assertions are occurrence, completeness, classification, accuracy, and cutoff. So the procedure to address occurrence is you would request the GL listing from management, making up the operating expense amount, and agree it to the trial balance and the financial statements to make sure it's complete and accurate. And then you would test from GL to invoice to payment. And then moving on to our second assertion, which is completeness. This is our assertion of interest, our main assertion. We can test this through subsequent disbursements testing. So in this process, in this procedure, you would select disbursements subsequent to your period end, such as outflows from the bank statement. So this is third-party evidence, which is very strong. It's very unlikely that the bank would omit an outflow of payment. So here, we would trace the disbursements from the bank to the invoice, and then from the invoice to the purchase order, and purchase order to management records, aka the GL, to assess if the amount was appropriately recorded, if it pertained to that year. So the logic behind this is because although management may understate or omit the expense on their records, regardless, the company will still need to pay out the vendor to maintain the relationship, to avoid late penalties, fees, or legal action. Hence, disbursements will always most likely be complete, and that's where we select our samples from. So to reiterate, so during the period, management may understate or omit the expenses, but after that period end, management will have to pay those expenses regardless. They will have to outflow and disperse from the bank statement regardless. Hence, we select from the bank statement and then we trace it back to that financial reporting period that we are auditing or performing procedures for. And then moving to our third assertion, which is classification. During the testing of the procedures above, we will inspect the description of the invoices to see if the nature of the description aligns to what we expect an expense to be, or should it be capitalized as a betterment. And as a quick review, betterments are costs that enhance the service potential of a PPE item. Indicators of a betterment are if the cost increases the output. So first, increases the output and service capacity of an asset. Second, increases or improves the quality of output. Third, extends or increases the useful life. And then fourth, helps lower operating costs by increasing efficiency or effectiveness. And then our fourth assertion is accuracy. During our testing procedures above as well, we would agree the details and the dollar amounts between payment to invoice to management records, aka the GL. And then our fifth assertion is cutoff. Same during the testing procedures above, we would agree the date of the expense incurred from the invoice to the date management recorded the expense. So for example, if the invoice says the expense occurred in May 2021, then the expense should be in management's record for 2021. Let's move on to our second tip, which is controls and WER. What are controls? Controls are processes to reduce the risk of misstatement in our outputs. Here's an illustration to show high level where controls fit into the big picture. Our inputs are, for example, journal entries prepared by the human that may have errors. Outputs, for example, is the financial statement or lines and amounts in the financial statement, such as operating expense. We've covered direct testing of the outputs earlier, which is RAAP. Controls are the processes in place between the inputs and the outputs intended to improve the quality of the outputs. When you're asked to assess controls, try to use the format WER, W being for weakness, I for implication, and R for recommendation. There are 5 main control types which you can use to implement in your recommendation. First is segregation of duties. Second is authorization, pre-authorization, and limiting. Third is documentation trail. Fourth is independent review and checks. And then fifth is physical and logical IT controls. In your implication, you want to emphasize to the reader why they should care. Quantify the problem and emphasize the severity and the worst case scenario. For example, someone can steal hundreds of thousands of dollars from the company through fraud. Let's walk through one WER example. Let's revisit our operating expense example above. Let's say the analyst who prepared the operating expenses journal entries by accident omitted that third expense. So the weakness here is the analyst is able to prepare and at the same time post and book expense entries into the system without any review. Therefore, no one reviews if the expenses that month are complete and reasonable. The implication is this could result in errors, such as that third expense item being omitted, or fraud. For example, the analyst can book any expenses they want, such as 100 grand, and although the expense was only 50 grand, the analyst can pocket the other 50 grand and record it as an expense. So recommendation, we can implement 3 types of controls. First is segregation of duties, second is authorization, and third is documentation trail for this example. So first, with segregation of duties, the analyst will prepare the expense entries. However, have the prepared expense journal entries with the supporting invoices be reviewed by a manager before the entries can be posted into the system. A second set of eyes can catch invoices or expense that were not prepared. And then for authorization, the manager will evidence his review by sign off on the journal entries. The manager's authority is appropriate as he has a higher position than the analyst. And then third is documentation trail. We want to keep the records of the journal entry, evidence of review and approval, and the invoices safely stored on the ERP, such as SAP, to be accessible by internal and external auditors in the future. Moving on to our third tip is special reports. The goal for special reports is to meet the minimum requirements and minimize the cost for the user. So for special report analyses, to achieve depth of special report discussions, you want to do 4 things. First is to identify the requirements of the user. Second is to explain characteristics for each report and why it was recommended. So for example, cost of the report, the level of assurance and opinion required. Third is historical financial information, or are we assessing projected forecast into the future, and why is this report relevant or applicable to the user and situation. And then third, explain the type of work expected for each type of report and the example procedures. So for example, if it's a review, it would be inquiry and analytical review. If it's an audit, then it would be inquiry and a combination of observation, inspection, confirmation, reperformance, recalculation, and verification. And then fourth is to provide at least two report alternatives. One, the first reasons why this type of report shouldn't be used, and then a second one where reasons why it should be recommended. Explain which report would not be appropriate, and conclude and recommend which report would be ideal for this user and situation. I'll go over 5 types of special reports. First is CAS 805, which is audit of single FS or accounts of the financial statements. Second is CSAE 3530, which is specific, relates to specific compliance of contracts or agreements. Third is CSAE 3000, which is audit of non-financial info. Fourth is CRSE 2400, which is a review engagement. And then fifth is section 9100, which is results. There's no opinion, no assurance. The first 3 types of report offers the highest or high level of assurance where information is audited and needs to be reasonable. CRSE 2400 aims for plausibility, involves inquiry and analytical review, which is comparisons to prior periods to look for any unusual trends. This type of report provides negative assurance. So the report states that nothing came to the auditor's attention to indicate that, for example, revenue was not fairly stated. So the difference between plausibility and reasonability are: the conclusion for plausibility is not an opinion. Conclusion that nothing has come to the practitioner's attention that would cause them to believe that the FS do not present fairly in all material respects to the accounting framework. Versus for reasonability, the conclusion is the opinion on whether the FS is prepared in all material respects in accordance with that accounting framework. For plausibility, the cost is lower. For reasonability, the cost is higher. The advantages for plausibility is that it requires less time, less energy, and less cost, and less testing and work is required. For reasonability, the advantage is that you provide more comfort and confidence for the intended users of the FS. Therefore, for example, let's say a bank, there's less collateral for the loan, less interest rate for the loan. The previous 4 reports, we looked at historical information. Section 9100 is specifically for the future, where we look at projections and forecasts. You cannot provide assurance over financial projections and forecasts because they are in the future. They haven't happened yet. What you can do is provide reasonability of the assumptions underlying the forecasts as opposed to the outcomes, and comfort on the application of specified procedures and calculations on those financial forecasts. You need to discuss the specific requirements with the user, for example, bank or lawyers needing the comfort to perform the specified procedures they require, allow the users to input into the procedures performed to focus on areas that they are most concerned with. Again, section 9100, there's no opinion, but the procedures performed would be outlined in the report and the results of the procedures. So for example, let's say you wanted to perform procedures on the forecast of sales and sales growth. you can compare sales growth. So part of your procedures, you can compare sales growth to industry data, marketing studies, internal budgets, and past information. It is ultimately up to the users to interpret the results for reports under section 9100. So this brings us to the end of the video. If you guys found this video helpful, like, a comment, a subscribe would definitely help the YouTube algorithm, and I would definitely appreciate it. And you might find future videos useful, so subscribing might kind of notify you of those videos. Thanks again for watching, and I will catch you guys in the next video.